Cast your mind back to early 2025. Markets are hitting all-time highs, tech stocks are soaring, and everywhere you look, one word is driving the entire rally: artificial intelligence. Nvidia's stock has quadrupled in 3 years. Microsoft's market cap has blown past $3 trillion. And AI startups you've never heard of are pulling in billions at valuations that would make even the most seasoned investors blush. It feels unstoppable. It feels like the future, but as a student of financial history, I've seen this movie before, and I know exactly how it ends. Segment 1: The pattern beneath all that euphoria. A pattern is quietly emerging. A very familiar pattern, one I studied in the wreckage of 2000, when the dot-com bubble collapsed and the Nasdaq fell nearly 80%. But here's what's different this time, and what makes it far more dangerous. The money isn't just flowing into AI companies. It's flowing in a circle. The same capital appearing on multiple balance sheets as revenue. The same hardware being financed and repurchased by partially owned subsidiaries. History has a term for this. It's called a financial Ouroboros, a snake eating its own tail. And when you examine the math, it simply does not add up. Segment 2: The circular financing machine. Let me walk you through exactly how this works. A massive chip manufacturer, let's say Nvidia, invests billions into a small AI startup. That startup then uses that exact cash to purchase chips back from Nvidia. Nvidia records this as revenue and growth, which sends their stock price soaring. But here's the problem. No real value was created. The money simply moved in a circle. This practice has a name. It's called round tripping. And it was central to multiple scandals during the dot-com era. Companies like Enron and WorldCom used similar mechanisms to dazzle Wall Street, right before collapsing overnight. Today, we're watching it happen again. But on a scale that makes the 1990s look almost quaint. Consider the evidence. Nvidia recently proposed a $100 billion pledge to support OpenAI's data center expansion. Sounds impressive, until you realize OpenAI will use that capital to purchase Nvidia's own hardware. The money flows out as investment and returns as revenue. Microsoft has invested $13.8 billion in OpenAI and holds 27% of its for-profit entity. In return, OpenAI has committed to purchasing up to $250 billion of Azure cloud capacity through 2032. That is $250 billion flowing right back to Microsoft. Amazon committed up to $8 billion to Anthropic. Then Anthropic committed to $30 billion of Azure compute running on Nvidia systems, with Microsoft and Nvidia investing another $15 billion to make that happen. And perhaps the most explicit example, Elon Musk's AI is structuring a $20 billion special purpose vehicle to buy Nvidia GPUs and lease them back to xAI. Nvidia is reportedly contributing $2 billion in equity to the same vehicle while also supplying the hardware, effectively financing a portion of its own future sales. Venture capitalist Azar described this ecosystem as a financial Ouroboros. That's not hyperbole. It's a precise description. When you aggregate these arrangements across the industry, you see something deeply troubling. Growth that appears explosive, but is largely internal to the ecosystem, not driven by real external customers or genuine economic value creation. Segment 3: The cash burn crisis. Now here's what almost nobody is discussing. These AI companies are hemorrhaging cash at rates unprecedented in technology history. OpenAI provides the most dramatic example. According to Microsoft's own financial filings, OpenAI lost more than $11.5 billion in a single quarter. That's an annualized burn rate of approximately $46 billion. This isn't a controversial estimate, it's straightforward arithmetic. OpenAI currently spends $3.30 for every dollar it earns. Deutsche Bank projects $143 billion in cumulative negative free cash flow through 2029, noting that no startup in history has operated with losses approaching this scale. Why is this happening? OpenAI trains its models on Nvidia GPUs accessed through Microsoft's Azure infrastructure. Every time someone uses ChatGPT, OpenAI pays Nvidia's margin, plus Microsoft's margin, plus its own operating costs. It's like paying rent to 3 different landlords just to open your shop. Compare that to Google, which trains Gemini entirely on its own custom tensor processing units. No external GPU purchases. No cloud provider margin stack. According to semiconductor research firm SemiAnalysis, Google's GPU infrastructure delivers 30 to 44% lower total cost of ownership than Nvidia's systems. This cost gap isn't a temporary growing pain. It's structural, and it widens with every additional query served. The market is beginning to notice. Gemini reached 650 million monthly active users in Q3 2025. Meanwhile, Chat's US traffic declined 35% in November of that same year. Even Mark Benioff, the Salesforce CEO who had used ChatGPT daily for 3 years, publicly announced he had switched and wasn't going back. Segment for the phantom earnings problem. But there's another layer to this story that even sophisticated analysts are underestimating, what some are calling a $176 billion depreciation arbitrage. Phantom earnings that simply vanish when you apply realistic accounting. Here's how it works. Traditional servers were historically depreciated over 3 years. Then, in 2020, Amazon quietly extended that schedule to 4 years. By 2023, all 3 major hyperscalers, Amazon, Microsoft, and Google, had normalized on 6-year depreciation schedules for their infrastructure assets. This matters enormously. By spreading the same capital expenditure over twice the original time period, companies dramatically reduce their annual depreciation expense and thereby inflate their reported earnings. But in January 2025, Amazon made a striking reversal, shortening the useful life for AI and machine learning hardware back to 5 years. Their stated reason: the pace of technological change in AI means each new GPU generation renders prior generations economically uncompetitive almost immediately. The accounting impact was immediate: $700 million in additional annual depreciation, reducing net income by roughly $300 million per quarter. And yet, other hyperscalers have made no similar adjustment. The same physical hardware, identical GPU equipment, is receiving dramatically different treatment across different balance sheets. The secondary market confirms this suspicion. GPU cloud rental rates have collapsed from approximately $8 per hour for H100 equivalent capacity in early 2024 to around $2.10 per hour by late 2025, a decline exceeding 70%. In under 2 years, multiple providers are offering capacity below their own cost of capital just to maintain market position. This behavior is entirely consistent with hardware whose true economic value is depreciating far faster than the accounting suggests. Analysts estimate the cumulative impact of this depreciation arbitrage reaches $176 billion through 2028, phantom earnings that would largely evaporate under realistic accounting assumptions. Segment 5, the infrastructure trap. Now, you might be thinking, this is just growing pains. Demand will catch up. Let me show you why the historical evidence argues otherwise. In 2025, hyperscalers committed approximately $400 billion to capital expenditures, up 70% from the prior year. Goldman Sachs estimates this figure will reach $527 billion by 2026. To justify that level of investment, AI infrastructure would need to generate approximately $2 trillion in annual revenue by the end of the decade. That is an extraordinary figure, and the path to it remains entirely theoretical. To fill the financing gap, the industry has turned to private credit, a market that now manages close to $2 trillion in assets and is growing at 17% annually. But here lies a deeply familiar danger. GPU equipment is being used as collateral for loans financing the purchase of additional GPU equipment. If GPU prices continue falling, as they already have, the collateral evaporates while the debt obligations remain fixed. And then there is the constraint that no amount of capital can simply overcome: electricity. Hyperscale data centers operating at 100 megawatts or more are now standard. A single 1 gigawatt facility requires approximately $10 billion in construction costs and another $20 billion in GPU hardware, while consuming energy equivalent to 100,000 homes. To meet projected AI compute demand, the United States would need to build 75 to 100 gigawatts of new generation capacity by 2030. New power generation typically requires 3 to 5 years to construct. Data centers are being built on 2 to 3 year timelines. This mismatch is not a minor planning error, it is a hard physical ceiling on expansion. Segment 6, Smart Money Moves Quietly. History has taught me to watch what sophisticated investors do, not what they say. In November 2025, Peter Thiel's hedge fund sold its entire position in Nvidia. This is the same investor who made legendary bets on transformative technology trends. The exit came as Nvidia itself faced margin compression from rising input costs. SoftBank, one of the most bullish AI investors of recent years, saw nearly $50 billion in market capitalization wiped out as AI bubble fears gripped markets, despite posting paper gains in its Vision Fund. And in late 2025, Google DeepMind CEO Demis Hassabis issued a stark public warning suggesting that many AI startups are riding a bubble that could soon burst. When one of the world's foremost AI researchers says this, someone with full visibility into what the technology can and cannot do, it is worth listening carefully. Closing, the historian's verdict. The dot-com crash that peaked on March 10, 2000 saw the Nasdaq fall 75%, wiping out $1.75 trillion in value. The telecom collapse that followed in 2001 was worse, $1 trillion in obligations, much of which was never repaid. This AI infrastructure bubble carries greater systemic risk than either. The financing is leveraged, not merely equity-based. The interconnection between hyperscaler balance sheets means a problem at one company ripples through the entire ecosystem. And the circular financing mechanisms mean the true scale of leverage is hidden across multiple revenue lines simultaneously. When these arrangements unwind, and historically, they always do, revenue evaporates across the entire chain while companies simultaneously face both collateral impairments and debt obligations. This is not a prediction of immediate collapse. The more likely historical parallel is a grinding compression, a 18 to 36-month period where the gap between infrastructure build-out costs and actual end customer revenue gradually closes, destroying enormous value for those who entered late. 3. Things I'd watch as a student of these cycles. 1. Recognize that circular financing, not genuine end customer demand, is driving current valuations. When vendor financing unwinds, compression is rapid and brutal. 2. Read the depreciation schedules in financial statements. Companies still using 6-year assumptions for GPU hardware are overstating earnings. That is not opinion, it is arithmetic. 3. Watch insider behavior, not public statements. When sophisticated capital exits quietly while promoting loudly, history tells us what follows. This is precisely why I study financial history, because the patterns repeat, even when the technology changes. If you want to understand those patterns before the market teaches you the expensive way, subscribe to Fiscal Historian. I'll see you in the next one.